I hope everyone's having a great start to the week. It is beautiful here in sunny Chicago. It is 76 degrees, so I'm sure that other other people on the call are enjoying some warmer weather in various places across our beautiful country. So, Ellen, Ben, how's your week been so far?
It's been great.
My week, pretty good. A little busy, but
All we can ask for. So, well, let's get started. Thank you, everyone, for attending today's Q2 2025 Town Hall. I hope everyone's having a great start to 2025. As a quick reminder, what I like to do at least once a quarter is to provide updates on what we're seeing within the markets, what to expect, updates within our firm, within LPL, all that good stuff. We do like to make this concise, no more than 15 to 20 minutes. As always, we have the dream team on the call, Ben Storm
everybody,
and Ellen Vaughn with some exciting news.
Hi, everyone. I just wanted to quickly share a new benefit that we're offering that we think will be helpful to many of you. I recently became a certified notary public. We decided to offer this because in the financial world, there are often documents that need to be notarized, and we noticed that clients were sometimes scrambling to find someone last minute. So now whether you need something notarized for estate planning, financial transactions, or really anything else, you can either stop by our office, we'd love to see you, or if it's more convenient, I'm happy to come to you, obviously anywhere in the Chicagoland area. Or if Elliot wants to put me on a flight to, let's say, Palm Springs or Florida, I'd be happy to do that too. But really, it's just one more way that we're working to make things a little bit easier and more seamless for our clients. So super excited about that. But I'll pass it back to you, Elliot.
Wonderful, wonderful. Well, congrats again, Ellen. That's awesome. Um, as always, I do have to provide some basic disclosures. I'll put this on the screen right now. Investment advice is offered through IHT Wealth Management, a registered investment advisor. This is general education and not advice. Please do not take anything from this presentation today as advice to alter your portfolio. Always consult with a tax professional. Again, this is general education. We're providing this again for our clients because there has obviously been a lot of noise over the last couple of weeks and over the last couple of months. So not just right now, given what's gone on with the market, with the news, but ongoing, we think it's important to make sure that we're communicating our thoughts and communicating what we are doing, adapting, changing to environments and changes with the law, taxes, et cetera, that remain fluid. So today we will be getting into tariffs, the market, what's going on. I know it's been a pretty crazy Q1 and start to Q2. Whenever there's breaking news, we will be producing immediate emails summarizing the events along with our thoughts on the events. So, for example, we sent out an email about DeepSeek a couple weeks ago when China announced they had produced an AI that rivaled ChatGPT. We also produced one about tariffs. We'll continue providing these newsletters, but I don't want to inadvertently be spamming our clients with content and emails that they may not want. So if you would like to receive emails regarding ongoing investment updates and what's going on within the news, please either go to theharborwealth.com/publications and go to it's again, the publications tab. You'll find the investment newsletter sign up tab. Otherwise, just shoot us an email saying, hey, I'd like to be getting the investment update newsletters, and we will gladly put you on that list. As always, I'm going to be going through the JP Morgan Guide to the Market. You can find this online anytime. It's free to download. I pay very close attention to Dr. David Kelly. He's the Chief Global Strategist at JP Morgan. So today is not only going to be a mix of his views and our views, but a combination of other economists that I follow very closely. That being said, I want to make sure that if anyone joins the town hall via direct dial, they do not need to be able to see the screens to be able to get most of the information. I will always do my best to talk through the graphs that we're seeing. That way, again, you're getting most of that information. Again, and I think it's important, at least today and maybe going forward as well. I want to acknowledge that we'll be covering topics like tariffs and inflation and subjects that at times have been politicized in the news cycle. And I want to be very clear. This is not about politics. The insights I'll share come directly from research and trusted economists, including Dr. David Kelly at JP Morgan. My aim, as always, is to provide perspective, not opinion. I think that's the foundation of all my advice and extends to everything we share in these town halls and everything we share in general. So, with that, I'm going to dive first and foremost into kind of what everyone's been asking about and waiting for, and let's dive on in, and that is tariffs. So I'm going to share my screen. Ellen, Ben, I want to make sure. Can you see my screen? Okay.
Yep.
Beautiful. All righty. This is not another graph. This is a rather unique graph. It is telling a powerful story about where we've been and where we might be going. If you look back to the early 1900s, tariffs, which are in essence taxes on imports, reached roughly 35%, nearly 30% back again in the early 1900s, which is pretty high. Then during the Great Depression era, tariffs spiked again. But for decades after, we lived in an era of relatively free trade with low tariff rates. Now we're seeing something of a bit of a reversal. Initially, economists expected tariffs to rise to 20%. But because of some of the carve outs that we've been seeing over the last couple of weeks, smartphones, semiconductors, and other goods, we're actually seeing closer to a 17 to 18% tariff rate. Now, you might wonder, why does this matter? Well, when the cost of importing goods rises, companies tend to pass that cost to you, the consumer. And that can influence everything from inflation to the prices at grocery stores to even how much we pay for the new smartphone. I just heard or read, I think it was on Bloomberg maybe a week or two ago, that there was a massive influx of people buying new phones before tariffs started taking place. And that's, I think, the bigger idea. Markets adapt, companies adjust, consumers make smarter choices, and over time, equilibrium returns. The key is to avoid emotional reactions to short-term headlines. I'm now going to turn to page 27 because we just discussed, again, kind of the inflation impact. So on page 27 of the guide, we see inflation dating back to January of 2018. Now, inflation has come down. It's now hovering around 2.4% as of March 2025, which is awesome. That's great progress. But if you look down at the bottom right hand of the graph, you can see a little orange and a little green. Energy prices and core goods have actually helped bring inflation lower a bit over the last month or two. But there's a twist, because what we think we are seeing is some businesses and consumers are rushing to buy goods ahead of the tariffs. That short-term surge in purchases had a mildly deflationary effect. Again, this is what we think we are seeing. So oddly enough, tariffs initially made inflation look a bit better. But it's important, again, to add context around this. It's not a straightforward cause and effect. If tariffs stick around, we'll likely see some upward pressure on prices again, especially for imported goods. The key takeaway here is simple. Inflation is dynamic. As you can see on this graph, there are multiple different components: energy, food at home, shelter, core goods, dining, auto insurance. There are a lot of variables to be considered here. And it's not just the number, it's a reflection of how we as the consumers live, spend, and adjust. I think to compound that a bit more, I'm going to turn to page 17 of the guide. This illustrates and represents the last 25 years of GDP growth. GDP is just a measure of our economy's growth, the United States. And over the last roughly 25 years, we have averaged around 2.1% a year. That's modest, but consistent. Now, in Q1 of 2025, we saw a small contraction. We were negative 0.3%. Now, that sounds scary until you understand why. The answer, net exports. We imported far more than we exported, creating a negative 4.2% drag on GDP. This goes back to the item that I was just addressing. More people were buying a lot of products, trying to get, these purchases in before the tariffs hit, where we had a massive net import, influx. Now, is that bad news? Not necessarily. It tells us that Americans are buying. It also tells us that global trade dynamics are in flux. This isn't a recession. It's a reminder that economies breathe and sometimes they exhale. So, where do we go from here? Well, I think the entire, I don't even want to just say the financial world, but I think for anyone that has ever tried to invest or pays attention to the market, we're pretty shocked a couple days ago when Warren Buffett announced that he was going to be retiring soon. So with that in mind, I wanted to quote one of his famous phrases: "Be fearful when others are greedy, and be greedy when others are fearful." And I think page 20 proves the wisdom of that quote. This graph that we are looking at shows consumer confidence in the stock market. And it dates back to 1971. Where are we now? We're near all-time lows. And people are scared. But that's what happens when sentiment, what happens when sentiment gets this low. On average, the S&P 500 returns 24.1% in the 12 months that follow whenever we see these troughs, whenever consumer sentiment is relatively low, when people are fearful. Let that sink in for a second. In the moments of the greatest fear have historically been the moments of the greatest opportunity. There's a man that I have followed for a number of years, Nick Murray, and he would say, you don't get out of the market when it rains, you bring in an umbrella and you stay invested. And that's kind of the point. And that's going to continue to be the point of everyone and every review that we have together. It's stay the course. There are most definitely potentially storm clouds on the horizon, but there are still a lot of reasons to be optimistic. I'm going to turn to page 16 now of the guide. This has annual intra-year highs and lows. And I think this, again, goes to the point I was just saying. This may be my favorite chart in the entire guide because it shows the truth about the markets and that most investors never hear. And also, I think it exemplifies the points that I had put in our newsletters and kind of what we had been discussing leading up to the latest newsletter. And that is what we are seeing right now and what we have seen this year at its worst. From peak to trough, our economy is down roughly 19%, or the stock market was down about 19%. That's not a bug in the system. It's a feature. Since 1980, the market has averaged around a 14.1 drop within every year. Every single year, we have seen an average of a 14.1% drop. That's the emotional roller coaster that we all feel, and that's not going to stop. But here's the catch. In 34 of those 45 years, the market still finished positive, 75% of the time. So what does that mean? Volatility is not a bug. Again, it's a feature. It's the emotional toll that we play and pay to earn these long-term returns. If you felt uncomfortable this far this year, if headlines have made you nervous, remember, This is not this is not something that we haven't seen before, and this unfortunate discomfort that I am here, Ellen and Ben are here to help you through, is the price that we have to pay for the meaningful long-term growth that we have seen, again, since, and just in this case, since the 1980s. So I can't predict the next headline, but I can tell you that your financial plan is designed to weather storms like this. And I'll stop sharing. Um, if you'd like to stay more connected, we've added more to our website at theharborwealth.com. You can, again, sign up for our investment updates under the publications tab. That way, there's more market whenever there's major market or policy events, whether it's, there's forecasts of the Tax Cut and Jobs Act potentially being extended or altered or changed, or if there is an adjustment to the Secure Act or adjustments with the market or something new, we'll not only send you our thoughts, but we'll help you understand it without the noise. As always, our door is open. If you have any questions about your investments, your plan, or the markets, please reach out. That's why we're here. If you have any questions again for any of us, please let us know. Thank you as always for our time or for your time. We hope that this is enjoyable. If there's any other questions that you want us to address independently, just give us a call. Thanks everyone and have a great week.